Joining me now is Grant's Interest Rate Observer founder and editor, Jim Grant. And Jim, it's always a pleasure to see you. Thank you for being here this weekend.
You are entirely welcome, Maria. Wouldn't be any place else.
There was that article in the Journal the other day saying, oh, you know, Trump's allies are planning this big restructuring of the Federal Reserve. Meanwhile, it's President Joe Biden who gave a speech the other day and said, we're going to get an interest rate cut, and it's going to be a month delayed. I mean, like, did he speak with Jay Powell? Is he messaging to Jay Powell to cut interest rates? I mean, talk about, you know, not having the independence of the Federal Reserve. We've got a sitting president telling us that an interest rate cut is going to be delayed by a month. But,
right,
you know, oftentimes...
Yeah,
go ahead.
He is, Joe Biden, speaking in the long tradition of Presidents Johnson and Nixon and Roosevelt, FDR, and Truman, of course. I don't think there's much new here, except the reaction, perhaps, on the part of Janet Yellen. You know, what is a little bit new, Maria, is the dependence of the Federal Reserve on the Treasury Department. The Fed, as we would say in the private sector, is broke. Now, this sounds like a provocative word, and it's certainly a disturbing one. But every week, the Fed reports its own finances. The form is called the H41 form. And it shows that the Fed has got a witness will now consult his notes. The Fed is $123.6 billion in the hole to the Treasury. It's borrowed that much against its mounting operating losses. You know, it pays out 5.5% or so, and it earns 2% to 3%. So that's no way to get rich, and the Fed is duly losing money, a lot of money. So the Fed shows negative capital.
It's a really important point that you make, and I appreciate you making it. Jim, I want to get your take on the macro story. On Friday, we got the jobs numbers, weaker than expected. That sparks a rally in stocks, as I guess we're back to believing that the Fed is going to cut interest rates at some point. How do you see things, Jim?
Well, I think the Fed dearly wants to cut interest rates. The legacy of a dozen years of 0% or so rates, the legacy of the era of money growing on trees has been one consequence, an important consequence that has been an enormous buildup of debt, both in business and in government. And what business and government don't need is higher rates of interest. However, if the Fed means to protect the integrity of the dollar, that is to say, it means to hold down the rate of inflation, it has to address that with higher rates. That's kind of what it has. It's a tool it has. So everyone's hoping and praying for lower rates and exhaling mightily when they seem to be getting them.
Do you think there's still a chance we see a recession in the second half? Nancy Lazar from Piper Sandler is telling clients she's sticking to her base case that we see an economy in recession in the second half because things are slowing and are not all that good when you actually peel back the onion. And she's also saying that that will send unemployment up above 4%. Your thoughts?
Well, Nancy is one to agree with rather than to disagree with, so that's view is to be respected. You never know. Yeah, I mean, I have expected a recession for the following reasons. I've expected one because the yield curve is negatively sloped, meaning that high rates are higher than long ones. Short rates are higher than long ones. Money supply growth had tailed off dramatically. But lo and behold, the long-anticipated recession has never yet materialized. But Nancy is certainly on point that there is a strong possibility.
Okay, we will leave it there. Jim Grant, always a pleasure. Thanks so much.
Thank you, Maria.
Okay, good to see you.